Hello there, my fellow crypto degenerates. Welcome to another Tuesday episode of Fat Bear Pod. I'm your host, PB, the bear who hodls. All right, let's start with the big daddy, Bitcoin. The king of crypto's pumping, flirting with 90K. Is this the real deal or just another bear trap waiting to happen? Time will tell. The total market cap's at 2.8 trillion, up a modest 2% from yesterday. Meanwhile, the 24-hour trading volume's gone full beast mode, spiking 30% to 90 billion. Bitcoin dominance is up to 63.6%, tightening its grip on the market like a jealous ex. The fear and greed index currently at a jittery 38, about to get past the fear and into neutral zone. For alt's performance, the winners are Fartcoin, Deepbook, Pixels, and Thundercore. The losers are Treasure, Mantra, Ergo, and Engine Coin. Now, let's pivot to some macro news that's got the fiat world sweating harder than a miner in a bull run. The IMF just dropped a fresh world economic outlook, and it's got some spicy takes on the Eurozone. They've slashed their growth forecast for 2025 to a measly 0.8%, down from 1%, and 2026 is now at 1.2%, down from 1.4%. Why the doom and gloom? Two words: tariff uncertainty. Trump's trade war antics, slapping 10% tariffs on everyone and up to 50% on some countries, are making Eurozone suits nervous. The IMF's warning that trade tensions could tank growth faster than a shitcoin after a hype cycle. ECB's Christine Lagarde is out here clutching her pearls, saying the region's fragile economy might take a bigger hit if the U.S. keeps playing tariff roulette. Meanwhile, Germany and France are already shrinking, and Spain's the only one pretending everything's fine with 0.8% growth. Look, I've seen enough market dumps to know that when the IMF says uncertainty, they mean brace for impact. Next up, we're diving into some spicy crypto news. South Korea's Bithumb is pulling a classic crypto glow-up move. The exchange is spinning off its non-core units faster than a shitcoin dumping after a pump. They're prepping for a big-time IPO in the second half of 2025, and they want to look all sleek and shiny for investors. By July 31st, Bithumb's non-exchange businesses, think venture investments and whatever else they've been dabbling in, will be shoved into a new entity called Bithumb A. The core exchange, Bithumb Korea, stays put, ready to strut its stuff on South Korea's Kosdaq, with whispers of a NASDAQ listing if they're feeling extra. Bithumb's coming off a hot 2024 with a 560% profit spike to $110 million. So they're flexing those numbers like a crypto bro showing off his Lambo. But let's be real, I've seen enough exchange shenanigans to know this could be a slick move to hide some baggage. That recent raid over their ex-CEO's alleged apartment fund embezzlement? Yeah, not exactly IPO friendly. Will this split make Bithumb the next Coinbase? Or is it just lipstick on a pig? I'm betting on a rug pulled somewhere in the fine print, but maybe that's just my crypto PTSD talking. Next story. The full Federal Court of Australia has flipped the script on crypto lender block earner, handing them a massive W against the Australian Securities and Investments Commission, or ASIC for short. The court overturned a 2024 ruling that claimed block earners' fixed-yield crypto lending deal needed a financial services license. Not only did they squash that, but they told ASIC to cough up block earners' legal fees, which, let's be honest, probably cost more than my entire altcoin portfolio. ASIC's appeal to slap penalties got yeeted, and now they're considering their next move, which probably means sulking in a corner. Block earners shut down the earner product back in 2022 when ASIC started sniffing around, and they've got no plans to bring it back. Smart move, considering regulators are stickier than a honeypot scam. This ruling's got people hyping it as a green light for crypto investment. But let's not pop the champagne yet. I've been in this game long enough to know that one court win doesn't mean the regulators won't come back with a vengeance. Still, it's a rare day when a crypto firm gets to dunk on the suits, so I'll take it. Last crypto story. Paul Atkins was sworn in as the 34th SEC Chairman, and the crypto crowd's popping off like it's 2017. Atkins is waving a big old olive branch to digital assets, a far cry from Gary Gensler's Sue First, ask questions never playbook. This guy's got $6 million in crypto investments. Seems like he's one of us, or at least rich enough to fake it. Atkins looks like the guy to greenlight 70-plus crypto ETF applications, from XRP to Dogecoin to something called 2X Melania. Bloomberg's Eric Balkin has called a wild year incoming, and I believe him. Sounds like a circus I've already bought tickets to. Atkins co-chaired the Token Alliance and has been preaching clear regulations forever, so the SEC's already dropping cases left and right, including big ones against Ripple and Coinbase. But I've been in crypto long enough to know that pro-crypto regulators can still rug you. With Atkins' Senate promise of a rational and principled framework, the market's betting on ETF approvals and maybe even a Ripple settlement. But let's not get too cozy. His $327 million net worth screams Wall Street insider, and those guys don't always play nice. Time to switch gear to some DeFi news, starting with the launch of Hyperlane. Hyperlane's finally dropped its Hyper token, and it's making waves bigger than a whale's market order. This interoperability protocol, which connects over 140 blockchains like some kind of cosmic switchboard, launched its token generation event today. The Hyper token's here to power cross-chain messaging, staking, and governance, with a total supply of 1 billion tokens and a starting circulating supply of 175.2 million. Now, here's the part that's got the community grumbling louder than my stomach after a bad trade. Hyperlane's handing over 5% of the total Hyper supply to Binance like it's passing out candy at a parade. That's 2.5% for a hodler airdrop to BNB holders, and another 2% for a TG campaign via Binance Wallet. Priced at 3 cents a pop to raise $600,000. This Binance move? It's like inviting your rich uncle to the party and giving him half the cake. Sure, listing on Binance guarantees eyeballs and liquidity. It's a gut punch to prioritize BNB holders over loyal users. Next story. Kinetiq's partnering with Veda Labs to launch a vault that's got Hyper EVM stake curves drooling. This Kinetiq Earn Vault is an automated DeFi strategy for K-Hype stackers, designed to chase the juiciest yields across Hyperliquid's DeFi ecosystem without you lifting a finger. I'll admit, it sounds smoother than a trade on Hyperliquid. The vault lets you stake K-Hype, Hyperliquid's native token wrap for DeFi, and auto-scouts the best opportunities, whether it's lending, liquidity pools, or some other yield hack on Hyper EVM. Kinetiq Earn sounds sexy, but automated yield can mean black box if you're not careful. Where's my K-Hype actually going? What's the risk of a smart contract exploit? And let's not forget Hyper EVM is still a young chain. 38% of Hype's distribution goes to ecosystem incentives, which is great for growth, but smells like a liquidity trap waiting to happen. I've been rugged too many times to believe and set it and forget it without a catch. Still, if you're a K-Hype hodler, this vault could be your ticket to milking Hyper EVM's DeFi boom. Last DeFi story. RedStone, the Oracle outfit serving data to over 150 clients across 70-plus chains, is launching a buyback program for their Red token, and it's got the market buzzing like a miner's GPU. RedStone plans to funnel a chunk of their revenue into scooping up Red tokens to build a strategic reserve. They kick things off with an initial $500,000 buyback, but the details are murkier than a shitcoin's white paper. Implementation will depend on market conditions, whatever that means. Buybacks sound sexy, but often smell like a PR stunt. RedStone's not saying how much revenue they're committing or how often they'll buy. Could be a one-off $500,000 flex or a drip feed that barely moves the needle. And with Binance suspending their Red spot listing over airdrop drama, the token's liquidity is already shakier than my trust in centralized exchanges. Plus, buybacks don't fix underlying issues like competition from Chainlink or the risk of Oracle exploits. There's no clear percentage of revenue pegged to the program, so don't expect transparency to rival other oracles. We got a hot topic for all you airdrop hunters out there: how to farm the Paradex. Paradex is a decentralized perps DEX built on Starknet that's got everyone whispering about. If you missed Hyperliquid's drop that turned farmers into overnight ballers, Paradex is being hyped as the next big trade-to-airdrop play. 20% of their Dime token supply is earmarked for community airdrop. Step 1's depositing into their Gigavault for a low-risk play. You can score above 20% APR on stablecoins while earning XP. Deposit at least 100 USDC, and you're in the game racking up points just for parking your funds. For the high rollers, trading perps is where the big XP flows. Pick a pair, set leverage, and open positions. The more volume you push, the more points you stack. Supply maker volume, the Paradex's order books, can net you points weekly, proportional to your share. It's like yield farming, but with extra steps and a side of market-making stress. That's all for today. Keep your wallet secure, your trades tight, and your hopium locked in a vault. This is PB, signing off.